Welcome to Talk Tensors, where we unpack the latest and greatest in machine learning research. If you're keen on getting up to speed quickly on ML, especially for something complex like stock market forecasting, you're definitely in the right place.
Absolutely.
Today, we're doing a deep dive into a really interesting new paper. It uses a novel spin on the Mamba architecture, which, has been gaining a lot of traction.
That's right. And it tackles a really persistent challenge. How do you accurately predict stock movements? It's not just about one stock, it's the whole interconnected system. We've come a long way from older statistical methods through RNNs, CNNs, transformers, and now these Mamba models. But finance, especially stocks, has its own unique quirks.
Exactly, and this paper zeroes in on that. It's titled, let me get it right, Hierarchical Information-Guided Spatio-Temporal Mamba for Stock Time Series Forecasting.
Bit of a mouthful.
Yeah, definitely. But it tells you a lot. The core problem, as you said, is capturing both individual stock weirdness and the broader market trends, plus how stocks influence each other. Apparently, standard Mamba models weren't quite cutting it for that specific combo.
Precisely. Mamba's great for long sequences, very efficient, but just plugging stock data into it, well, it misses the spatial aspect, the connections between stocks. And it often doesn't look beyond the historical price data itself.
So what's the fix? This paper proposes something called HIGSTM. That's HIGSTM. Hierarchical Information Guided Spatio-Temporal Mamba.
Right. The idea is a hierarchy. Look at individual stocks, then look at how they interact dynamically over time, and look at the stable, long-term global picture. Plus, crucially, they try to weave in macro information.
Making the model more market-aware, essentially. The end goal, obviously, being better investment decisions, more informed trading.
Exactly. So shall we unpack how they build this?
Let's do it. Maybe start with the context. The paper lays out a bit of history, doesn't it?
It does. It positions stock forecasting as, well, obviously super important for investing. They walk through the evolution RNNs like TPA LSTM, then CNNs like TCN, then the big transformer wave with models like Crossformer, iTransformer, Patch TST.
Which were a huge leap for sequence data in general.
Huge leap. And then they get to the more recent Mamba-based stuff like by Mamba and Time Machine, but they argue these still had limitations specifically for stock forecasting.
Right, those two main points you mentioned earlier. Difficulty modeling the interstock influence, that spatial part, and relying mostly on just past prices, not broader context.
Exactly, and that's the gap HIGSTM aims to fill with its hierarchical structure and this idea of information guidance.
Okay, so tell us about this structure. It starts with decomposition.
Yeah, the first key component is something they call index-guided frequency filtering decomposition. It's a pretty clever way to start.
Index-guided, so using market indices like the S&P 500, or in their case, Chinese indices like the CSI 500?
Exactly. The goal is to separate out what's just general market movement, the commonality, from what's unique to each specific stock, the specificity.
How do they do that? With frequencies.
Right. They use the fast Fourier transform, FFT. Think of it like breaking down the complex sound of an orchestra into the notes played by each instrument. FFT breaks down the time series signal into its underlying frequencies and their amplitudes, their strengths.
Okay.
So they transform both the individual stock price series and the market index series into this frequency domain. The key idea is that the strong frequencies in the index likely represent broad market trends.
Ah, I see. So you use the index's frequency signature to figure out what's common noise?
Pretty much. They analyze the index's frequency amplitudes to create filters. These filters are then applied to the individual stock frequency data to separate it into two parts. XFC, the commonality in the frequency domain.
Right.
And XFS, the specificity. Then they use the inverse FFT to bring these back into the time domain, getting XC commonality and X's specificity for each stock.
So you end up with two time series for each stock, one reflecting the market tide and one reflecting the stock's own little boat, so to speak.
That's a good analogy. And crucially, that specificity series, X's, is thought to contain the clearer signals about how stocks might be uniquely related once you've stripped out the market noise.
Makes sense. So decomposition done. What's the first layer of their Mamba hierarchy?
First up is the node-independent Mamba. It's pretty straightforward. They take the original raw stock data, X, and process each stock's time series completely independently using a standard Mamba block.
So no connections between stocks at this stage, just looking at each one in isolation.
Exactly. The idea is to capture the intrinsic features, the basic temporal patterns of each stock on its own, before considering how they influence each other, like, analyzing a company's internal financials before looking at its competitors. Establish a baseline.
Okay, baseline established,
Yeah.
then things get more connected.
Then things get more connected. The next layer is the temporal information guided spatio-temporal Mamba, or TIGSTM. This is where the dynamic time varying relationships come in.
Temporal.
Yeah.
So short-term changing interactions.
Precisely. And it incorporates time-specific macro info. It has two main parts. First, temporal section sparse neighbor aggregation. They use that specificity series we talked about. At each time step, they use an attention mechanism to figure out which other stocks are most correlated with a given stock right now.
Attention, right. So the model learns which connections matter most at that specific moment.
Exactly. And they keep it sparse, only focusing on the top 30% most important neighbors for each stock at each time step. This creates a dynamic graph of connections that changes over time. Then they aggregate information from these dynamic neighbors.
So it's not assuming fixed relationships like these two stocks are always related. It learns it dynamically. Using the specificity helps find those real connections beneath the market noise, I guess.
That's the idea. It captures those evolving, sometimes subtle interstock dependencies. The second part of TIGSTM is the temporal information guided selective state space model.
Cool.
Here, they take the commonality series, XD, aggregate it across stocks for that time step to create a sort of time-specific market signal, MS, and this signal is used to guide the Mamba block.
Guided how?
They incorporate this MS signal into the input and output selection matrices within the Mamba architecture itself. So Mamba's core mechanism, how it selects and processes information through its state space model, becomes aware of the market conditions at that specific time step.
Ah, okay. So TIGSTM is modeling dynamic relationships and letting the current market mood influence how it processes the sequence. Pretty sophisticated.
It is. It's trying to capture both the local dynamic structure and the immediate temporal context.
So that covers the individual and the temporal dynamic. What about the G in the HIGCM, the global part?
Right. The final layer is the Global Information Guided Spatio-Temporal Mamba, or HIGSTM. This one focuses on the more stable long-term patterns and the overall market context.
Stable and long-term. So complementing the dynamic TIGSTM layer.
Exactly. Again, two parts. First, global neighbor aggregation. They take the specificity series X's again, but this time they aggregate it across all time steps to build a static global correlation graph, GGU. This graph represents the persistent, long-run relationships between stocks. They use attention here too, but build a denser, fully connected graph initially to capture these broader connections.
Okay, so TIGSTM is like looking at today's social network buzz, while GHGSTM is like mapping out the long-standing family relationships, capturing the underlying market structure.
Good way to put it. Then the second part is the Global Information Guided Selective State Space Model. Similar to TIGSTM, they create a macro signal, but this time it's a global one, MG, derived perhaps by aggregating the time step signals, MS, from the TIGSTM layer.
So an overall market condition signal.
Right. And again, this global signal MG is fed into the Mamba block's selection mechanism for this layer. It helps the model learn those stable relationships while keeping the overall long-term market context in view.
So just to recap the hierarchy, node-independent Mamba for baseline individual stock features. TIGSTM for dynamic short-term relationships guided by time-specific market info, and HIGSTM for stable long-term relationships guided by global market info.
You've got it. That's the core structure.
And how do they get the final stock prediction out of all this?
The output from the final GIGSTM layer goes through a simple linear layer to map it to the prediction target. Interestingly, they don't just predict the return, they use mean deviation prediction, predicting both the expected return and the likely deviation or risk around it.
Oh, interesting. Predicting volatility, too, in a sense, and the training loss.
They use a Pearson correlation coefficient loss. The idea is to get the ranking right, which stocks are likely to outperform others rather than just minimizing the error on the absolute price prediction. Useful for portfolio strategies.
Right, relative performance often matters more. Okay, so that's the model. How did it actually stack up in their experiments?
They tested it pretty thoroughly on real-world Chinese stock market data, CSI 500, CSI 800, CSI 1000 indices, and they compared it against a whole suite of models, spatio-temporal ones like ASTGCN, MTGNN, and also strong pure temporal models like iTransformer, TimesNet.
Yeah, the results.
Pretty impressive, honestly. HIGSTM came out on top across basically all the key metrics on all data sets. Things like information coefficient, IC for accuracy, profit and loss, P&L from simulated trading, Sharpe ratio for a risk-adjusted return, win rate, WINR,
Wow.
profit loss ratio, PL.
Wow, state-of-the-art across the board.
Yeah, the tables in the paper show significant improvements over the baselines. The Sharpe ratio improvement was particularly notable.
That's key. It suggests the higher returns aren't just from taking wild risks, but genuinely better forecasting, better risk management.
Exactly. They did note slightly higher maximum drawdown in one specific comparison, but the overall risk-adjusted picture painted by the Sharpe ratio was much stronger for each ESTM.
Did they do ablation studies, like take bits out to see what mattered most?
Yep. They removed the HIGSTM layer, the GIGSTM layer, the decomposition step, the index guidance, and performance dropped significantly each time. It really showed that all those components, the hierarchy, the decomposition, the information guidance, were crucial. They also tuned hyperparameters, of course.
And they visualized the graphs the model learned, the temporal versus global ones.
They did, and it matched intuition. The temporal graphs were sparser, highlighting strong, often industry-specific connections at certain times. The global graph was denser, showing broader, more stable, sometimes cross-sector relationships.
They had a case study too, right? On a specific stock.
Yeah, Kwaichow Mutai, the liquor giant. Its temporal neighbors were mostly other liquor companies, as you'd expect, but its global neighbors were more diverse, reflecting maybe broader market capitalization links or something else. It shows the model capturing different kinds of connections at different levels.
And comparing graphs learned with specificity versus without.
Also insightful. Without filtering the market noise, i.e. without using specificity, the learned correlations were much weaker, more washed out. Using specificity really helped identify the strong, meaningful interstock links.
Okay, and finally, the backtesting simulations.
Showed higher overall returns for HIGSTM, performing particularly well in uptrends, though maybe slightly more volatile than some simpler models, which aligns with the slightly higher drawdown observed sometimes. But again, much better risk-adjusted returns overall.
So stepping back, this EGSTM really seems like a targeted response to the known limitations of applying earlier sequence models, even Mamba, directly to the messy, interconnected world of stock markets.
I think that's fair. The history went from simple stats to RNNs struggling with long memory, CNNs capturing local patterns, transformers handling long dependencies but being computationally heavy and not inherently spatial, and Mamba improving efficiency but still lacking that built-in spatial awareness and context integration for stocks.
And HIGSTM brings that hierarchy, that clever decomposition using indices and the information-guided Mamba blocks to address those specific gaps.
Right. The hierarchy handles different scales of interaction. The decomposition cleans the signal, and the information guidance makes Mamba market aware. The strong empirical results really back up the design choices.
Okay, fascinating stuff. Let's shift gears slightly to our novel notions segment. Based on this paper, what kind of future research directions does it spark for you? Any interesting extensions?
Well, one thing that comes to mind, building on their information-guided idea, what if you integrated more external information, like real-time news sentiment or key economic indicators?
So not just the market index signal they use, but maybe processing news feeds or Fed announcements.
Exactly. Imagine feeding embeddings from news articles or macroeconomic data directly into those information-guided selection mechanisms in the HIGSTM and GIGSTM layers. So the Mamba blocks could modulate their state selection based on breaking news or changing economic outlooks, not just price history and index trends.
That could make the model much more reactive to sudden events.
Right.
Things not yet fully reflected in the price action.
Potentially, yes. It could improve predictions during high volatility or when major news hits. You'd need to draw on research combining deep learning with external knowledge, maybe natural language processing for the news sentiment.
What's the catch? Could it just add noise?
That's the risk. Integrating diverse data sources effectively without confusing the model is always tricky. But the potential for a more proactive, event-aware model is, I think, quite high. Medium probability, maybe. Technically feasible, but needs careful design.
Interesting. Okay, what's another idea?
Another thought, perhaps a bit more ambitious. What about making the hierarchy itself adaptive?
Adaptive. How so?
Well, right now, HIGSTM has this fixed 3-layer structure. Individual, temporal, global. but maybe the relative importance of these levels changes depending on the market regime.
So in a very choppy market, maybe the short-term temporal dynamics, HIGSTM, matter most. But in a strong, broad bull market, maybe the global context, GSTM, is more dominant.
Exactly. So you can imagine perhaps using meta-learning, a system that analyzes current market conditions, volatility, correlations, maybe even how well each layer predicted recently, and dynamically adjusts the emphasis or even the depth of the hierarchy.
So the model could sort of zoom in or zoom out its focus automatically based on what's happening.
That's the idea. It would require exploring adaptive neural architectures, meta-learning. It's definitely more complex to implement and train than a fixed structure. The potential payoff is a model that's robust across very different market types, but probably lower probability in the near term. It's a challenging concept.
Still, a really cool direction to think about. Adapting the model structure on the fly. Okay, just a quick reminder to everyone listening. These are purely speculative research ideas for discussion. Definitely not investment advice.
Absolutely. For entertainment and academic curiosity only.
Right. So wrapping up our deep dive here on Talk Tensors, this HIGSTM paper really feels like a solid step forward for stock forecasting with Mamba.
There you go.
The key takeaways for me are that hierarchical structure, the clever index-guided frequency decomposition to separate signals, and that information-guided selection within Mamba, making it market-aware. It addresses some very specific limitations of prior approaches.
Yeah, it's a well-thought-out architecture tackling a complex problem.
We definitely encourage you, if you're interested, to dig into the paper itself. We'll have it linked. The details on the math and the experiments are worth exploring.
And it leaves you wondering, doesn't it? How could these techniques, hierarchical modeling for multi-scale interactions, integrating external contexts, be applied elsewhere? Think about climate modeling with its local weather, regional patterns, and global trends. Or even analyzing social networks.
That's a great point. Complex systems often have these nested dependencies. A really interesting thought to end on. Thanks for joining me today to unpack this paper.
My pleasure.
And thanks to all of you for listening to Talk Tensors. We'll be back soon with another deep dive into machine learning research.